Good afternoon. The market is closed. It's been closed for almost an hour now. It's 1:56 p.m. Pacific time on Tuesday, the 23rd. Um, anyway, the reason I'm doing this video today is to share what goes through my mind, some decision making, and then also diversifying my portfolio. I wanted to give a shout out to Joe Ryder. Joe Ryder is a real estate expert. He's been in the real estate market for over 30 years. He's in NorCal. I am a mentee of his. His YouTube channel is Being Real Real Estate, as well as his Instagram channel. Anyway, I wanted to free up some capital so that I can help some other mentees with gap funding and also with some syndications. So syndications are projects that, in this case, Joe would be managing and in charge of. And so I'm just a passive investor, which is great because I trust him on the real estate side much more than myself. And the returns are better than what most syndicators would offer. Anyway, what I'm going to do is show you some things I'm thinking about for freeing up capital. So on this column here, you'll see dollar amounts: 10,598, 69,000 something, 7,700, 23,000 something. All of this is tied up. It's potentially available when I need it to be, but to do so, I have to either A, let these dates pass where these options expire, or B, buy back these options for the value in this column. So this amount here, 17,231, that's kind of a lot. At least, for myself, I think it is for many people as well. If I were to buy back these 13 call options, then this would be freed up. Now, is it worth it? Well, I guess that's an opinion. So this expiration date is middle of February, plus we have about a week in January. So that's about 3 weeks out or so. And the thing is, this is in the money. I do not like options in the money if I am an option seller. I sold 13 of these and the strike is 415. Now the Qs, the underlying price is 423. So that is what, $8.48 in the money. That's what I would consider deep in the money. And so if I were to buy this back, I'd take a loss. I'd take a 2.5% loss, $414 loss. The thing is, what you don't see is the loss that I've taken along the way by arriving here. To get all the way to this point, I rolled call options out in time again and again. And by doing so, I've taken losses temporarily, but then I would sell other options to offset it. But it's still essentially a loss. The way this would win is if this expired worthless and this was down to zero. So what are the odds of this going to 415? Hard to say, but the market's been breaking new highs. It's been climbing higher and higher. It's an election year. There's talk of rate cuts, etc. So it's hard to say if this is going to go down to 415. Is it possible? Of course. Is it likely? I personally don't think it would go down to 415 between now and the 16th of February. If it does, that would be awesome. This would shrink in value, and I would buy these back for less than what I sold them for. It could still be a potential loss overall because of previous positions. However, it would be better than where it is right now. So a small loss obviously is better than a large loss. So now remember when I mentioned the $8.48 in the money. Now this is the current value. So 1325 minus 848, that's like four something. 400 and something dollars of the $1,325 is time value. So if I were to just sit here, let's say the market didn't move and we fast forward in time to February 16th. So if I did that before the market closes and this is still this price, this would be worth basically the difference between these two, which is the 848. So this would be worth less, which is good because I'm an option seller. This would be less, and it would be less than the 16,817. In that case, I could either buy it back or I could roll it, either one. If I bought it back, then this margin would be freed up. And this margin changes from time to time. Could be within the day, could be after the market's closed. It just depends on how the market moves. But these margin requirements are dynamic. These are not exact permanent numbers. So these puts, all of these puts, these are out of the money. And so they're already in profit. But I'd like to see it go into more profit by these shrinking in value. These are worth so little, to buy these back, it wouldn't be obviously nearly as painful as buying this back. So if you notice, I have 1 plus 9 is 10. I have 15 puts that I sold, and I have 13 calls that I bought. Now, why is that? Well, I didn't do it by accident. I added some additional puts that I sold because I think the market's going to go up. If the market goes up and I have puts that I sold or short puts, then I will make money with these, which would help to offset the loss that I have here. So you notice this loss, even though it's 13 positions, is larger than this gain. This is for today, even though I have 15 positions. So that's why I have more puts. In fact, if I add even more, it would take a little bit more margin, but it would help, even more so to offset this if the market continues climbing. So I can buy maybe a couple of these back. That would free up some of this margin too. It's not necessarily an all or none situation. I can do 1, 2, all the way up to 13 on buybacks, and it'll free up more of this. This number here, I have the 2 extra puts that I sold represents this. So these are 2 uncovered puts. That ties up 10,598. So let's say I bought this back for $28.50, and I bought one of these back for $47.50. If I were to do that, this would go away, and that would be an additional $10,598 that's freed up and available and withdrawable, which I can use for other things, other trades, gap funding for real estate investors. Now, gap funding, by the way, it's a different subject matter, but that's, let's say you see a house for $100,000. You won't find that in California, but let's say we see that in Ohio. So if someone can get a loan for $80,000, but they don't have the 20% down, they need gap funding, and that'll get them to 100% financing. Where do they go? Someone like myself, potentially, where I will put up the $20,000 for maybe 3 or 4 months. I'll expect a specific return. Obviously, we'll have a signed agreement or contract, and I'll make sure that I'm protected. If they do not pay me, then I put a lien on the property, or I'm part owner on the property. I do something to make sure that I'm secured, and maybe even in a better situation if they default than if they pay me. So some members in our group could use that gap funding, whether it's 20 grand, 30 grand, whatever the number is. If I have the ability to do so, sometimes I might make even more with gap funding than with trading. And it's really virtually no risk with the secured property. So that's that. There's other positions here, as you see, where money is tied up. Same thing. If I were to buy any of these back, I kind of look at the ratio. Does something free up a larger amount? This. So it would be a slight loss that I'm not really ready to take yet. Spend $5,625 to buy back these 18 calls and frees up 32,000. It just depends on your situation. But those are the thought processes that go through my mind. Also, looking at this, when do I buy back? When do I roll? And because there's 400 and something dollars in time value, if I can be patient and let this do whatever it does, it's going to shrink in time value, and it's just going to have the intrinsic value, but the pain will be less. So if I wait a little bit, I will take less of a loss. So anyway, I hope that helps. If it's confusing, type in some questions in the comments. Let me know. I'll respond. And again, thank you for watching. Have a wonderful day. Hit the subscribe button if you already haven't done so. And I'll see you on the next video.